Hi guys, welcome back to the channel. My name is Dave, and today I want to talk about JEPI and JEPQ from JP Morgan. And these are two really popular covered call ETFs. They've been out for a while. I bought them pretty much on day one when they came to market. They have about $70 billion of assets under management at this point, so that makes them the most popular covered call ETFs out there. They perform pretty well. But time changes things, and after looking at these investments, I've decided to make some changes. So I want to talk through that today. If that is what you're looking for, please stick around. Whoop. So one of the big changes that I decided to make this year in my income portfolio, which is just a segment of my full portfolio, is to rotate out of JEPI and JEPQ and into a couple of other funds that I think fit better for myself. Now, I'm still going to keep a small allocation to these funds for diversification purposes, but overall, it's been greatly reduced. So let's start out by quickly reviewing these two products in case you're not familiar with them. Now, both of these offer impressive yields. That's one of the reasons that people buy them. This one, for example, is 8.27%. Both offer a great selection of stocks that are handpicked by the people over there at JP Morgan, a well-known name, so you can feel confident that they're doing a pretty good job as far as the holdings go. Both of them have a relatively low expense ratio of 0.35%. We call that 35 basis points. You could also say that's $35 for every $10,000 that you invest. So that's pretty darn good for this category. It's still relatively high compared to some other products. Like if you buy the S&P 500, it's only 0.03%, much lower. And I always bark at this kind of thing, but just think about, they've got $41 billion of assets under management. If you take $41 billion times 0.35%, you get about $143 million in expenses that they collect off this fund. Pretty darn effective for JP Morgan. Now, both these funds use a covered call strategy, but it's a little bit different because it's buried within equity-linked notes, which are a little bit more complex instrument. They're not that transparent. It's hard to find the information specifically on how they're writing out those notes and what the options look like inside those notes. But it is a covered call fund, so there's covered calls within that fund. And that also introduces counterparty risk. Not a big deal, but something to consider. You're not going to have that with something like SPYI from NEOS, for example, just as a comparison. That's how they're different, but still effective with what they do. So expense ratio 0.35%, pays you every single month, yields 8.27%, $41 billion of assets under management. And if you scroll down, you're going to see all kinds of great analysis here over at Seeking Alpha, so be sure to check that out. Holdings wise, if you jump in here, you're going to see technology is still number one for JEPI, and certainly that'll be the case for JEPQ, which we'll look at here in a second. But it's going to be hand selected by JP Morgan, and you're still going to have that diversification within the S&P 500, but it's narrowed down to 125 stocks. You're not getting the full S&P 500. They're hand picking their stocks out of this grouping. Okay. So, and I don't even think it has to be in the S&P 500, but the majority would be. So in this case, NVIDIA is still number one. Now, one of the things that I like, it's very well balanced. You can see the top 10 holdings. Number one is NVIDIA at 1.7%, whereas Emerson Electric at number 10 is 1.44%. So well balanced. Not all your eggs in one basket. And you can see that these top 10 make up about 15 or 16%. So there's still plenty going into the rest of these funds, into the rest of the stocks. But we have NVIDIA, Oracle, Meta, Microsoft, Train, Amazon, Visa, MasterCard, Southern Company, and Emerson Electric to round out the top 10. So a pretty solid fund. If you just look at the holdings and if you look at the summary, what you're going to find is a great group of stocks and then these equity-linked notes to generate some additional income that they distribute on a monthly basis. Now, the sister fund to JEPI is JEPQ, the JP Morgan NASDAQ Equity Premium Income ETF. This one's going to function the same way. We're going to have the same expense ratio. It's still going to pay you every single month. But we're going to see a spike in the yield up to 11.22% because we're dealing with these growth stocks, right? We're going to be more NASDAQ heavy. So we're going to have more exposure to more volatility. And because of that, they hope to capture more yield that they can distribute out to us. And that's been the case. This one's performed better than JEPI. Now, as far as holdings go, you're still going to have a lot of overlap. We're still going to be tech heavy, communications, consumer cyclical. But it's definitely going to be more of an emphasis on those stocks. So what we were at like 1.7% for NVIDIA, now we're up to 8.5%. So a significant jump with our exposure to some of these tech stocks. Same with Microsoft, Apple, and Amazon, Broadcom. So all great stocks, still great hand-selected stocks. 108 in this case. But more of an emphasis on these big growth mega cap stocks. Alphabet, Meta, Netflix, Tesla, Costco round out the top 10. So again, everything else being the same, but a focus and an emphasis on these growth stocks. Now, I didn't talk about dividends when I talked about JEPI, but it's kind of the same setup here. So if we jump over here and we look at dividend history and I scroll down, we're going to be able to see what we've been doing here over the last several years. And you can see how much it varies, right? We go from 38 cents down to 34 cents up to 68 cents. So it can float around quite a bit with these two funds. And some people, they don't really like that. They want a consistent line across here. But in reality, when you're selling covered calls and we're capturing income and we're trying to get money to distribute, it's not consistent. So when other funds try to hold that consistent, there is a give and take here, right? There's going to be months when they shouldn't be doing that and months when they probably have a little extra, and they try to balance that out and target something. With these two funds, it's more of an honest approach. They're trying to distribute what they actually earn every month. So you can kind of see how the months are going. But from an income investment standpoint, somebody that wants a consistent level of income, these do vary quite a bit month to month. By the way, all the charts I've been showing come from Seeking Alpha, and I am a Seeking Alpha affiliate. Personally, use Seeking Alpha every day, not just for getting updates on the market, but also for research on the many alternative ETFs that I cover. So if you're looking for a stock and ETF research tool, consider Seeking Alpha and check out the links below for discount offers. So overall, both these funds are doing a pretty decent job. And I think if you're expecting a bear market over the next year or two, you might keep your money right here. I think that's why you still see $41 billion of assets under management with JEPI. However, I've been selling and rotating into some other products. So why? Well, other options that are in this category are simply performing better. You know, the stocks selected with these two funds are solid stocks, but it just hasn't been bearing the fruit with that hand selection. And the broader based covered call funds are simply doing better. So if we look at a chart here of JEPI since it started trading back in 5/20 of 2020, we do have some decent history, which is nice, and it's done a decent job. It lags when the market runs, and it catches up when the market takes a breather. You can see that right through here in the middle. But overall, not terrible. And for many, I think that distributable income keeps investors happy. But we are still lagging by a considerable amount for total return versus the S&P 500. So if you look at it since inception, you see that big separation when we have these little bull runs or recovery periods. So up 132% total return for VOO, the S&P 500, versus 79% for JEPI. Now, if we look at a one-year chart versus some other covered call funds, and I know 1 year is a short period, but if we compare versus some competitors, we see that some of these other funds are doing a better job of capturing that upside during those recovery periods. So this happens to be a pretty good year, right? Early on, we had the tariff situation and we saw a sharp decline, and then we've had this incredible recovery since that period. So here's the 1 year chart, total return. JEPI lags all of the following. First of all, the straight up S&P 500 is up 18% versus about 9% for JEPI. Another one that I like and that I own is DIVO. This one's up about 14%. So this one sells covered calls against a select number of stocks within the portfolio every month. It also handpicks a selection of stocks just like JEPI. It just doesn't sell against the full fund. It doesn't distribute as much, but has a better total return. SPYI, the one from NEOS, is up 17%. And GPIX from Morgan Stanley is up 16.75%. These are the two that have been getting a lot of my money lately, as far as the ones that are based upon the S&P 500. Then we can also look at the NASDAQ side of it. Again, they're hand selecting here for JEPQ, but if we look at total return over last year and compare it to some other similar products, you can see again that it lags a little bit. So still a great fund, but up 16.8% versus 23% for QQQ. QQQI, again from NEOS, up over 23%, close to 24%. And GPIQ, again, from Morgan Stanley, up nearly 22%. So it's just not quite keeping up from a total performance perspective, especially during this recovery period, right? You can see where it was, you can see where it lagged behind, where everything else started to pass it up and model the underlying just a little bit better. And the second reason that I'm rotating out of these two funds and into some others has to do with tax efficiency. So in my case, which might be very different from yours, I'm trying to build an income portfolio for cash flow. I'm trying to build up cash flow while I'm still working. So I'm in a pretty high tax bracket. When I looked at my tax situation early on in the year, I noticed just how inefficient these were from a tax perspective. So I wanted to get out of these into something equivalent that would be more tax efficient. So I did this video, I'll link it up above, and you can see it on this chart. So I categorized 34 different funds that were in that income portfolio that I'm building, and that's what you see here. So if you look at number, let's see, 26, JEPQ, and you follow across, we're going to see that's around 34% based upon my estimations and what was reported to me. If I go to JEPI, same thing, up around 32%. It's a little bit lower because there's a few more stocks in there with qualified dividends, but that's the only reason. That option income that comes out of those equity-linked notes, it's ordinary income. There's no way around it. However, with some of these other funds that don't use that, they use straight-up options that I'm rotating into, they can be really tax efficient. So if I go down towards the bottom of this list, I'm going to see some of the ones that I just mentioned, right? GPIX down here at 6.15%. That's quite a different story for myself. GPIQ down here 1.75%. And then 4 and 3 down here at the bottom, SPYI and QQQI. For me, a lot of this was return of capital, and while I'm still earning a lot of money, makes a lot of sense. Down at 1% approximately for each one of those. And it makes a big difference when I'm looking at it from a cash flow perspective. So in summary, and just to be clear, I think these are pretty solid funds. If you have them in your account, I'm not saying sell them. I'm just saying that for me right now, it makes more sense for me to rotate into something else. And if you do own them, just remember you got $70 billion of people that agree with you. So I think they're good funds, especially if you're looking towards something that might be a bumpy ride going forward. Keep it in there. They're producing pretty good income for you. But think about your tax situation, I guess, is one thing that I would suggest. Now, if you want more information on covered calls, I've been talking about these covered call funds quite a bit lately, so you can check out either one of these videos. There's some truth here. There's some recommendations maybe here. We'll see what comes out when I finish the video. But either way, if you like this type of thing, like and subscribe. And I appreciate you watching. Have a great night. Take care. Whoop.